Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.
I was on mute. Welcome to another episode of the Tech Behind FinTech. Really excited to be here. Today's going to be an amazing episode. I'm joined by an amazing guest, Denis Brosnan, Portfolio CEO of the CORA GROUP. Dennis, how are you doing today?
I'm great, Nambi. So great to see you, and happy Friday.
Yeah, happy Friday. This is our second conversation. Our first was at Money 2020, and now we promised that we'll do a longer discussion. So today is the day for that. The show title today, Secrets of a Serial Acquirer, What Makes a Company Worth Buying. So before I jump into Denis and introduce him and read his bio, let's do some housekeeping. We are streaming live from Facebook, LinkedIn, and YouTube. At any point in time, you could jump in, ask questions, and it'll be part of the show. We also have a separate stream going from Instagram, which is direct. All right, let me introduce my wonderful guest. Today, we welcome Denis Brosnan, a seasoned executive and portfolio CEO at the CORA GROUP, where he oversees multiple companies in fintech, loyalty programs, and compliance technology. With over a decade of leadership in financial services, insurance, and real estate, Denis specializes in M&A, business transformation, and growth strategy. He also serves on the board of the National FinTech Organization, leading its education committee. With a Juris Doctor from the University of South Carolina School of Law and a BS in Management from Clemson University, Denis brings a unique blend of legal, business, and technology expertise to his leadership roles. Denis, welcome to the show.
Hey, thanks, Nambi. It's so great to be here. Really appreciate the time.
So look, I want to jump into it. When I first met you at Money 2020, I found it fascinating because you had your portfolio companies there. And, just for our audience, can you just give us a brief overview of what exactly you do in terms of at the CORA GROUP?
Yeah, sure. I'm the portfolio CEO of the FinTech portfolio at CORA GROUP. And most people, I'm sure, have never heard of CORA. CORA is a subcomponent of Constellation Software, Inc., which is probably the largest software company in the world that no one's ever heard of. We have a very unique business model. We're a public company headquartered in Canada, and we acquire and operate what we call vertical management software companies, and we own about 1,400 of them around the world. We do probably 140 plus acquisitions a year, and we never sell our businesses once we acquire them. And so we operate the software for life, and we typically operate the businesses in more or less decentralized fashion. So hence why no one's ever heard of Constellation. They're accustomed to the brand that they deal with every day versus Constellation, right? So as you might imagine, with that many software companies, we have software that does just about anything you can think of. For instance, we have a lot of software companies that manage fitness centers and stuff like that. I know you like to work out. And so if you went to the gym this morning, you likely checked in on our software and you don't even know about it, right? And so to manage that many, we have various layers of our organization, and everything is kind of done at a portfolio level. So my job as a portfolio CEO is kind of two things. One is I deploy capital. So I'm looking for companies to add to my portfolio constantly. And then secondly is once they come aboard, I'm an asset manager. And so I work with the CEOs of those businesses and their management teams, and help. And truly, I'm here to help them grow the business and grow their careers. One thing that's really unique about our company that I love is the fact that because we're never going to resell an asset, it's going to be around forever, but we're not. So, a lot of CEOs talk about how they care about their people and they want to develop their talent. It's really a critical aspect of things that we do. It permeates all of our stuff because we do have to replace ourselves. Somebody's got to do our job once we're gone.
Extremely fascinated by that concept of never selling the portfolio company because, I look at in a simplistic way, I look at private equity similar to real estate, right? Like I'm a long-time real estate investor, right? We take a underappreciating asset, we try to make sure that okay, the after repair value could be worth something. We repair it, and that spread, that's the equity play. It's like, okay, we made it worth this much. Now we can either choose at that point from a real estate perspective to keep it or to sell it, what some people call flip it. Private equity, right? Some concept, take an underperforming business, put a new management team, new software, make it do what it do. It expands, keep it for a little bit and sell it. Why is the decision in Constellation to never sell the companies they acquire?
Well, I think Mark Leonard, the founder, obviously a genius level intellect. I think it started out with he bought the companies and he liked them. He didn't want to get rid of them. And there's some stories out there. He's kind of shy for publicity, but if you ever see a picture of him, it looks like he's a ZZ Top guy, but big long beard and all that. But it becomes at some point a self-sustaining business, right? The more capital we deploy, the more companies we acquire, and we're really we focus on operations, right? We're here to generate revenue and EBITDA, and all of our free cash flow we redeploy into acquisitions. So the more we create, the more we deploy, the more we create, the more we deploy. And the asset value really is at the parent company, Constellation Software, right? So the ticker symbol is CSU. It's on the Toronto Stock Exchange. Anyone can look at the history of that, and it's amazing. It's just amazing how much it's grown. It's now 90 billion plus in market cap and over 60,000 employees worldwide. So it's really amazing, And I get the private equity models. I mean, I was a private equity backed CEO three times before coming here, and that's great. And it's a different. Every investor has a different view, different thing that they're trying to do. Especially for your audience that may be potential sellers, just understand there's different flavors of investors and what they do. I do love our model because we're not on a treadmill. We're not looking to resell in 3 to 5 to 7 years. We get to make decisions. We are the definition of patient capital. So,
I like that term, patient capital. For those that might not know, can you break down what EBITDA is?
Yeah, so typically, I think it was coined by a Harvard Business School professor probably 30 plus years ago. I mean, dating myself when I was in business school, I think it had just come out. It stands for earnings before interest, taxes, depreciation, and amortization. And so basically, it's a proxy for net profit, right? We do EBITDA. We don't have the D because we don't carry debt. But essentially it's earnings. Right?
So back to the keeping it for the long term, what if you get into a situation where you purchase a company, acquire a company underperforming year after year after year, right? With the business model, you just can't dump that company. You have to fix it. Right. What happens in that situation?
Yeah, I mean, and we do that a lot. We do acquire a lot of assets that are either underperforming or flat out unperforming. and for me personally, transformation work is kind of what I've done throughout my career. So it's not really colored by numbers. Every situation is different, but it starts obviously with looking for ways to reduce expenses. In almost every business, there is some opportunity to do that, and particularly when we acquire assets that, I mean, our asset acquisitions are kind of in two broad categories: either owner operator type acquisitions or corporate carve outs, right? And what you find is in the former, maybe there's opportunity to reduce costs by using some enterprise relationships maybe we have with Amazon or Microsoft for the cloud stuff. I mean, who wants to pay those guys more money, right? And so if you can pick up 20% savings by doing that, that makes a big difference, right? Maybe there are some other cost rationalizations that we can do. And then, we look to, oftentimes we're looking for every opportunity we can to generate more revenue from operations, particularly revenue that we don't have to apply a lot of additional significant incremental cost to, right? So a lot of entrepreneurs, think that they have to create new products in order to generate revenue. And sometimes it's a matter of just increasing prices. Sometimes it's a matter of looking to add some component services or some component fee structures to different ways the software is delivered. And then lastly, it is transformation. So we are software operators, and we really know how to run software businesses because we have so many of them. We bring some frameworks, we bring some principles and some ratios to bear that just work probably better than maybe a lot of folks would do. I mean, in either one of those scenarios, you see a lot of commonality. Like a lot of entrepreneurs, they may have an idea and they may not have the depth of operational management experience that we have. Conversely, a lot of these corporate carve-outs, we kind of call them orphaned assets. They oftentimes get lost in the shuffle of some bigger strategic or whatever. And, folks are just not paying a lot of close attention to them. And, it's like if you leave a piece of equipment out in your yard for a while, it gets rained on and gets a little rusty and crusty, right? And sometimes, we just need to reinvigorate management a little bit. So those are the things that we do. All in the framework of still serving the customer and trying to take care of the employees, and it works, right? I mean, I'm proud to say now, obviously, we have to be very careful about our acquisitions up front. We have to, due diligence them like crazy, but they don't all immediately work out, and we have to dig in and figure out how to fix them, to your point.
That due diligence, because you're looking at it literally forever, keeping this asset forever, how does that due diligence look? What's involved in that process?
Yeah, so like I said, every investor has a different point of view, but it all starts with the revenue for the most part. And in software, we're looking for ARR, or annualized recurring revenue. So obviously, the more ARR, the better in terms of valuing a business. And the most basic form of ARR for software is license fees, right? And you all do this every day. We all do this, right? Even apps that you buy on your phone have a license fee attached to them, right? So that's ARR that you can count on, right? Some of the flavors of revenue can be ARR-ish, but not subscription, right? If there are recurring support fees and things like that, that counts typically as ARR. As you get into the area of professional services or consulting or transactional revenue, that's harder to consider to be, recurring, right? The flip side of the ARR coin is attrition, because we only have one shot at getting the valuation right. We're never going to we don't really care about the valuation of the business on day two. We have to be very focused on the customer churn. How sticky are these customers? At what rate are they turning over? At what rate is the customer base refreshing? What are some of the market issues that may be driving attrition versus another? Like one of our businesses is, for instance, they run the software that runs kiosks in malls. It's not in my portfolio, but as you might imagine, there's a lot of seasonality in that business, right? I mean, people stage up kiosks for the Christmas season and then should close up shop in January. And, at some level it's just math, but we have to look at that, right? And that's a big piece of it. And then the last piece of the financial side of this is customer concentration, right? So you have, if you have great ARR and you have very low churn, but you also have a very small population of customers, and if one of them leaves, that changes the financial picture pretty quickly. So we take a good look, obviously, at the financials. Secondly, we look really hard at the contract terms that you have with your customers. And so particularly in the context of an owner operator, and particularly in the context of FinTech, the FIs, they have a lot of muscle and they like to get good deals for themselves, and they can kind of push their tech vendors around, particularly if they're kind of startup-y. And so at some point, I mean, we don't buy a lot of startups. We buy businesses that are a little bit more mature, but at some point you have to flip the switch and kind of exercise some of your leverage in the negotiation. And so there's some key contract terms that we're looking for, and we're looking to see how the business reacts to those things. The biggest one is a termination for convenience. The banks love to put termination for convenience on their vendors. They love to say, okay, yeah, we have this great deal. And oh, by the way, whenever we feel like it, we can send you a notice to terminate on 60, 90 days notice or whatever. And we always push back on that. And I personally have done that throughout my career. It's not fair. It doesn't make sense. And we're looking to see if those things exist, because if you have a 5-year contract, but it's got a 6-month term for convenience, well, it's really a 6-month contract, right? Because that's basically what you can count on, right? And so we look for those things, and then we look for how well the sellers have enforced their contract terms. I mean, one of the keys is, like, a lot of contracts, or all contracts, should have annual price adjustments tied to, like, CPI, right? I don't know about you, Namdi, but every time I go to the grocery store, prices have gone up since the last time I went, right? And same is true for software operations, right? And so we typically put in our contracts an annual CPI plus 2% adjustment, and we enforce that. And it's really critical that entrepreneurs do that. Last thing that we do in diligence, and this is the most important thing for me, honestly, is once we get, the other ones are toll gates, right? But then I want to hear about the story, and I want to hear about the people. The entrepreneur stories I love. It's amazing what these folks do. They're the unsung heroes, I think, in our country. And I really want to know about their people. I want to know where they came from, how long they've been there, what they see in the business, do they want to stay? Because, like, for us, we don't bring people to bear. We're going to preserve to the greatest extent possible the existing staffing and the existing customers. And I want to know and understand that those people, love what they do, they love where they work, and they love their customers, and they're going to continue to provide that, because at the end of the day, great service comes from great people.
When you're going through a due diligence like that and you're talking to their people, how far down the line do you go? Do you have that base layer at, we're just going to talk to their execs? Do you have a next layer where you're interviewing the next step down? Like, how far does that go in terms of understanding and knowing their people?
Yeah, it depends on the business. Obviously, some of the businesses that we buy are very small. They could be 5 or 10 people. Some could be very large in terms of hundreds of people, right? So obviously, the smaller the business, the more likely we are to interview everybody, right? If it's a bigger business, we may go down to the manager or even supervisory level, depending upon how we feel about. So one thing that's kind of interesting about us is like, we have this kind of perspective that if the software has been around for a while, and we're typically looking at businesses that are at least 5 years old, if the software's been around for a while and it's making money, then it works. So we put we put more emphasis and due diligence on the finance elements that I described for you, the legal elements, and also the people elements than we do necessarily on the technology. So it's not that we're going to do, I mean, we do technology due diligence and our folks do that, but from our perspective, we're really interested in the operational folks, the folks that are dealing with customers, the folks that are dealing with implementations and with sales and the managers of the day to day. So if it takes getting down to a fairly low level to understand that and feel comfortable with that, we will do that. We're not trying to badger people, and these are not job interviews or anything like that, but like I said, we truly want to understand, how the business works, and so that we can have a point of view of how it's going to work after we buy it.
It's interesting with the going down and talking to their people, because sometimes I'm sure you've seen this during acquisitions when different staff members are brought in to have those conversations. They always think it's going to result in a reduction of staff. Like these guys are coming in to buy it. They want to reduce costs. They want to optimize operations, and so you have to justify your job almost. How does that work? Do you get those do you feel that type of energy during these interviews when you go to acquire companies?
100%, and that's one of the reasons why we do that. I mean, when we get to the point of management interviews, I mean, we're probably halfway through our diligence process or better. So we're feeling good about that the deal is going to get done. And so for me personally, as the asset manager, I need to get to know these people. I need to meet them, have dinner with them, get to talk to each other as humans. And it's easy for me to say that, yeah, we're not going to look to dramatically change the staffing and all that, in an email or on a call. But if we're sitting there together having a cup of coffee, it's a little different, right? And I mean, we're always going to have to do what's right for the business, and so there's never any guarantees. But our perspective is we're going to run the business with the folks that we have, and so we want to get to know them as humans. We want them to know us as humans, and it's really important that they not be afraid to tell us, how things are done and what's good and what's bad and what's ugly. I mean, as I say to my folks all the time, the truth is a great story. If there's something that's not right, we're going to figure it out anyway. And I'd rather know it up front than afterwards. And we're just folks like anybody else. We may use some buzzwords like EBITDA and stuff like that. And we always encourage them to say, look, just if we say something you don't understand, stop and ask us the question, right? Because these are truly conversations. They're not they're not interviews or anything meant to scare anybody. And hopefully what happens is that we proceed on, we close the deal, and then we have the kickoff, and we come on site, and we really try to make a big deal about that. It should be a happy day for everybody. Now the business is now part of one of the world's largest software companies. They have all the benefits and everything that comes with that, but also they're still the same folks, and they're still working with their colleagues, and it should be a happy day, and we go and have dinner and that kind of stuff. So that it becomes very cumulative if we do it right.
I like what you said in terms of, and I want to get it from this perspective, right? You have a company that may have as maximum 10, 15 people on staff, but they've been around for a while. Their software works. They have some big clients. And now the CORA Group, you're coming in and saying, you know what, this is a potential acquisition. what are some red flags that'll make you think twice?
Again, if we see customer churn, that's our biggest red flag, and we start drilling into the customer churn. We start asking questions why, and inevitably we'll kind of figure it out. And that's not necessarily a deal killer. It's just something we have to underwrite to, right? Because again, all we're really doing is building a model that's based upon discounted future cash flows. And if we have some doubt as to the future cash flows, then we have to, factor that into it. I also see a lot of, and back to the point about the truth being a great story, a lot of times, especially in an entrepreneurial situation, or actually, you know what, it happens in carve-outs too. They'll bring in somebody that's either a consultant, or if in the case of a carve-out, from a different part of the organization that they think presents well. And that really doesn't work for me, because I know that they're not doing the work, and I want to talk to the people that do the work. And that's a red flag for me. The third thing that's a red flag, and I would encourage any entrepreneurs in the audience, if you're going to go down this path, be committed to it, right? I know folks, especially in fintech, they see some of the multiples that fintechs were getting, especially during the unicorn phase. And so, hey, I want to kick the tires and see what I can get to. We can smell through that in a heartbeat. And we don't want our time wasted any more than we want to waste your time. If you're not committed to the process, don't get into it, because that's not going to bode well. I mean, one thing that's unique, I think it's true of any investor group, whether you're talking about us or a strategic or private equity, we're not going anywhere. We're going to continue to monitor the sectors that we want to be in. And so if down the road you want to come back around and you weren't really serious the first time, that's not to say we're not going to talk with you, but we're going to remember that, right? And the same is true from us. Sometimes we get accused of kicking the tires on folks, and I always tell them, look, I mean, you're not going to get that from me, right? Or maybe they may be, we're a huge company. Maybe somebody is, rubbed you the wrong way at some point. I'm sorry if that happened, but we're very busy. We're never going to go down a path with a company unless we would be serious about buying it.
I want to emphasize the 2 points, because I think it's a serious takeaway that folks can leave with, right? And I know, being a consultant, working at bigger financial institutions before, I can see the strategy play from a smaller organization. Say, you know what, we're going to talk to these guys. They're part of a $90 billion organization. Let's bring in some consultants. Let's present well. It's a temporary situation, and let's put our best foot forward. And I want to emphasize that you said that is the exact way not to go, because it's going to work against you. Where some people, right? Because the idea is, I want to put my best face forward. I want to get. I could hire a management consulting company, come in, they know what we do, they'll present it, show a bunch of charts. You obviously know those guys have not been there that long, and they're just literally people presenting what this company is doing, but they're not the workers. So, from one standpoint, they could go, this is a good investment. We're making a good investment in this But you're saying that's actually a red flag. And I want to emphasize that, because I think people would think opposite. I think most would think opposite, right?
Yeah, and let me be very specific. So oftentimes somebody will be posited to us on a call as this person's head of sales for us, and it turns out they're actually a contractor. Or this person is our COO, and they've actually been brought in on an interim basis or something like that, right? And they've put together a plan. That's completely fine. Right. I mean, a lot of, consultants exist for good reason, right? They have unique knowledge and skills and experience and that people need. Just don't misrepresent their role within the organization. If they're a contractor, they're a contractor, right? And if they're presenting a plan that is underway, then yeah, that's great. But we're also going to want to talk to the people that are actually implementing it. If they're presenting a plan that hasn't been implemented yet, then yeah, that really isn't very helpful, right? I mean, because we're going to, okay, we'll look at it, but we're going to have to come up with our own plan anyway, right? So it's just, it's just a matter of, again, of being truthful and being forthright about the people that you're putting in front, right? And by all means, in getting ready for this process, it's a scary process, particularly for entrepreneurs that have never done it before. They should rehearse. They should put their best foot forward. They should get professionals to the extent they want to help them get ready, particularly as it relates to putting together their books and records and all that kind of stuff, because that's super important. But again, it's just when it gets to the point of management presentations and the people that are involved, we should be talking to people that are actually doing it.
From an industry perspective, right? What are some trends that you see that's shaping M&A and financial services?
Yeah, so about 5 years ago or thereabouts, it seemed like maybe 7 years ago, there was this crest of the wave of fintech unicorns, and they were getting just massive valuations on multiples of ARR forward. In other words, so we look at ARR as it exists today, and a lot of folks were getting, their projections were counting as existing ARR. All that stuff, I think, has come back to earth largely. There are still growth businesses that still get very attractive multiples, and that's great, and those people deserve that. But I think that we're in an environment now where there's a little bit more realism as it relates to valuation of businesses, and that's good, because I think that some of that was too frothy and some of that was counterproductive. And unfortunately, sometimes when an entrepreneur doesn't get that number, they get defensive or upset about it. And that doesn't mean anything. It just means that the particular investor is not willing to pay that for that business for whatever reason, whether it's because of the business or something else. And so I think that's one trend. I think another trend is obviously the political environment currently has an impact upon M&A. I don't generally talk that much about politics or religion or diet. Those are the kinds of three things that tend to upset people, and everyone has a strong opinion, and we could all be wrong. And of course, nobody knows. It feels like this administration is probably going to be more M&A friendly for big companies down at where we operate. I don't know that it ever mattered anyway, so I just don't know, what that has to bear on fintech. I think the third thing is the latest buzzword is AI, right? You can't ignore that. And I've been around long enough. I've been through a lot of buzzword periods. Blockchain, data and analytics, Six Sigma, you name it. This one, I think, is probably here to stay. It's actually been around a lot longer than people give it credit for. I think a lot of money and capital will be deployed against things that don't work or won't work or don't have a good market use case for that. And then I'd also think, though, that there will be a lot of AI innovations that will be disruptive and that will be attractive to investors. I know we're like everybody else, we're putting time and effort and capital into AI and seeing how that affects things. I go back to, however, what I said before, the truth is a great story. If you don't have AI embedded in your platform, don't say that you do. right? That's, I mean, you can opine as to how AI could be involved in your platform in the future, and that's great, and we can talk about that. But don't tell me it's an AI platform if it ain't. You know?
So a few things on that, right? With the AI platform, is it a situation where, let's say, a fintech doesn't necessarily leverage AI to its fullest extent? They're brand new to it. They're not. Is that a plus or a minus? Here's what I'm asking, right? Because from an acquirer, you could go, you know what, your numbers look good, and with more operational efficiencies leveraging AI, our portfolio companies do it. We have the expertise to implement it. We could take this thing through the roof. Or is it the opposite?
I think it depends on the business, but I would say that if it's a quality business that is not incorporating AI, we're going to treat it as a quality business in our underwriting. And if there's an opportunity to use AI and to add it to it, and particularly if the entrepreneur has pretty good point of view and has vetted that out and has a plan for that, we'll give them credit in the valuation in the form of an earnout, right? And say, okay, yeah, we will, you achieve targets as a result of incorporating that AI and bringing that to market, and we're happy to pay for that, right? If that works. So we don't really have to take a point of view on it, if that makes any sense, right?
Okay. So looking at it from the smaller startup that got stable, one can say, okay, we're looking to be acquired. The founders might have been there from the beginning. They finally get acquired, and they say, okay, I know there's usually some clauses they have to work for X amount of time. With your model on keeping it forever, when some of them leave, how does that work? Or do most of them stay? What do you see there?
Yeah, it's about half and half, Namdi. About half the time the founder wants to leave, and about the other half the time they want to stay. Usually, if they want to leave, it's they're ready to retire, or some other life event has happened, and they're just ready to move on. About the other half the time, they do want to stay. They would like to de-risk that journey a little bit, cash in their equity and stay on in a role that suits them. And we're cool with either scenario. I love it when they do want to stay, and particularly if they are, I think all of us should aspire to do the things that we're good at and we love to do. So one of my acquisitions, the CEO just dearly loves going to trade shows. I think when you go to a trade show with him, he literally knows everybody. And why would I not support that? That would be crazy for me not to. And so we actually designed his job going forward around that, and he's happy as a clam, right? So that's kind of how we look at it.
That's definitely interesting. Now looking at it from your outreach, how does that process work? Because worked with some people before who are looking to buy companies, and it was a big process. It's like sales, like constantly calling, the outreach. How does that look like for what you do?
Yeah, it's fairly complex. This is an area, this is what, core to what we do. So we have a very robust M&A and business development group within CORA. Every constellation group has their own. We're very blessed in CORA to have a fantastic corp dev group. They do all kinds of trade show coordination for us, and outbound digital marketing and things like that to the folks that would be attending the trade shows. George Chalmers runs that group and does a fantastic job. And then we all have at our portfolio level business development folks whose job it is to handle the inbound inquiries and also just talk, set up meetings with the different entrepreneurs. And then, we either meet them in trade shows or on, video meetings or whatever. And, we build the relationships. It's a relationship based, transaction, and it has to work for everybody. Particularly, what's interesting is in both of those, types of scenarios, whether they be entrepreneurs or corporate carve-outs, the motivators are often the same, which is not something you would expect, right? So for the founder, obviously in both cases, the seller wants to recover, or to generate a return on their investment, a financial return, right? But that's not the entire picture, right? Typically, especially in this case of entrepreneurs that may be retiring or something like that, they've hired these folks, they've brought them up, they want to turn the business over to them, and they want to see their folks taken care of. And the same is true with their customers, right? Like I mentioned, they've been going to trade shows for 30 years and seeing their customers. They want to see that their customers are going to be happy with the acquirer and that we're going to take care of them too, right? So those are hugely important things for sellers. In the case of owner operators, ironically, it's the same in corporate carve-outs. So oftentimes we'll acquire a business from a strategic, and they either built it or they bought it, oftentimes as it was going to be a service extension or a product extension of something else that they already have. And either that worked out or it didn't work out as well as they wanted to, or they took a strategic shift in a different direction. But the same kind of fundamentals are true, right? They still have the customer. They still know and work with these people. They want their people and their customers taken care of. And the bottom line for both of those scenarios is they know that we can execute like crazy. We really are an M&A machine. So we try to make it as easy for everyone as we can. And since we buy with cash, no one has to worry about financing and stuff like that, right? So once we get down the path, it's most likely going to happen.
Right. So we ask a lot of questions pre-acquisition, post-acquisition right now, right? What are the most critical steps to ensure smooth transition once you buy the company?
Sure thing. And I think this is true from my private equity days as well. The first and foremost thing is to get out there and visit with the folks, right? Naturally, everybody wants to know, what does this mean for me? A, am I about to lose my job? B, if I'm not going to lose my job, am I about to lose my benefits? And then C, assuming I'm not going to lose my job, I'm not going to lose my benefits, do I need to start thinking about looking for another job? Are these people that I can trust? And, what do they look like? How do they act in person? Are they as nice to me standing up in front of the crowd as they were during due diligence? And so, get on an airplane as quickly as you possibly can, right? That's number one. Number two is the business has to keep going, right? One thing that's unique about buying a company as an asset versus, say, buying a house or a car. You go buy a car, somebody hands you the keys and you drive off the lot, right? The business is in flight. Transactions are happening. Customers are being serviced. And technology, there's lights blinking on a server somewhere, but it's still operating, right? And it has to keep operating. Work has to be done. Systems have to be maintained. Bills have to be issued. AR has to be collected. And so doing no harm is kind of the second thing, is to emphasize to everybody, like, okay, we got past the kickoff and HR's answered all the questions, and we've gone out and had dinner and had a couple of glasses of wine or whatever. Okay, tomorrow, come back to work and keep doing your job, right? So that's number two. And then thirdly, once the dust starts to settle a little bit okay, what is the plan, right? And so, again, this is maybe where our situation differs just a little bit. It differs a lot from a strategic, right? Because we are going to leave the operations in place. We are going to um, finance and legal and HR are centralized for the most part in our world. Obviously, in a private equity world, they would stay there. In a strategic world, everything gets sucked up. So that's one thing where there's a discrepancy, right? And then the other piece that I do with my companies is I'm going to bring the management team into the execution management disciplines that we do. I do not want to be reported to. I don't want people to add a bunch of extra work, but we have a framework that we go through on a weekly basis where we just talk about the strategy, what the goals were, and how the business is going. As an asset manager, that's my job, right? And that's worked very well for me over 30 years. And so I never want to get out of operations to some degree, right? I'm not going to micromanage folks, and it's their job to run their business, but it's my job to help them. And we take time out every Thursday, every one of my businesses, to work on the business a little bit for an hour together.
You probably answered it in your process, but I need to ask this, right? Because sometimes, companies, based on your due diligence, this is probably won't fall into your situation, but a lot of times, right? You could be in a situation where the company wants to get acquired, and they're going through that process. When they finally do, it's like, oh gosh, we finally did it. We got sucked up by this bigger organization. We're good. And some of that entrepreneurial, getting your hands dirty, being really innovative, coming up with creative situations at 11:59 p.m. Sometimes that diminishes in a sense because wow, we don't have to anymore. We're good. Everything's working out now. We have backers they have billions of dollars behind them. And they're going to keep us forever. So we're not going to go out of business. How do you keep that fire?
That is a fantastic question, and you could not be more correct. Particularly in an entrepreneurial system, I call it the rice cake syndrome, right? They started out their business and all they could afford to eat was rice cakes, and they were just trying to get to make enough money to pay the bills and pay their folks, right? And then they start, doing well, and they don't ever want to go back to rice cakes again, right? And so at some point, the appetite for risk taking and entrepreneurship gets diminished. That's oftentimes when we come in, right? And so I mentioned some of the frameworks that we do. They're not very complex. One of them is we call the magic quadrant, which I make fun of because it has 5 components as opposed to 4. But we look at expanding outward from the base of existing customers and existing products, right? And it's like, okay, how can we, without building product, sell more things to our existing customers, by tweaking things or whatever the case may be. And then how can we take those existing products and sell them to new customers and maybe even new markets, right? And then we start thinking about, okay, how can we start building new product? And for me, it's always outward and concentric circles. It's, building new products from the ground up. That is not our core competency. We are not a Microsoft or somebody that's going to generate a brand new piece of software. We're much more likely to buy that. But there are always product extensions, and there may be opportunities to just pivot a product a little bit and all of a sudden serve a different market segment. And so those are the kinds of analyses that we will do. And then, we will make some investment. We will trade some profitability for growth, if that makes sense, right? And but again, that's all kind of part of that kind of planning process that I described. And it probably begins in earnest a couple of months into the acquisition. And by the end of the first year of ownership, we have a pretty good point of view in terms of what that strategy ought to look like.
Last question. You've been in this business for a while. You've acquired quite a few companies in your experience. What advice would you give yourself, right, from your first deal? Everything that you acquired, you've learned, you've done. You go back to Denis Brosnan doing his first acquisition. What advice would you give yourself?
To be patient. I think I have learned so much. And I go back to my first deals when I was in private equity, and it was all about, okay, we need to continue to grow so that we can add asset value and deploy capital, and the pressure to deploy capital is very high, right? And where I am now, that's what we do. So yeah, the pressure is still there, but it's easy to get caught up in the caught up. And, you know, one of the old saying goes, the best deals are the ones you don't do, right? And, you know, it's easy to run over speed bumps or to run through stop signs in due diligence. And if those red flags that you were talking about before crop up, I mean, you can convince yourself that you've underwritten around those risks, but once you get the business, it could be an entirely different deal. And then, you know, you're adding additional work to the turnaround or transformation that you have to do in the business. So being patient and not being afraid to upset folks. I mean, the entrepreneur, or especially there's a banker involved, they're like, well, this deal's going to go next week. You know, somebody else is going to buy it. You know, you got to do this today. And, you know, maybe you do, maybe you don't. You know, so it's got to work.
Dennis, thank you very much for your time today. It was great talking to you. You're officially a friend of the show because I've talked to you twice now. So when things come up, I definitely would like to talk to you again. What we do for our guests is we give you the platform to people can find you, talk about anything that you want, and I'm going to get off stage so you can do that.
Namdi, it's been such a pleasure. I really enjoyed it. For folks that are in the audience, again, Denis Brosnan at the CORA Group. It's easy to find me on LinkedIn or thecoragroup.com. We love talking to entrepreneurs, and I personally love that. I love your stories. I respect you for the things that you've done, and no matter what, love to hear that. Also, you know, in corporate carve-out scenarios, you know, we are a great counterparty. But also personally, I've been around and done a lot of things, and I love helping folks out. And so if there's anyone out there that's a FinTech operator and they're not really sure about all this stuff and they don't understand, happy to take some time to chat with you and to answer any questions that you may have. Other than that, I hope you all have a great weekend. Thanks so much.
Hi guys, we put the CORA Group on the bottom so you guys can see the link. It's also in the comments, but it's thecoragroup.com, so you can visit their website. Thank you all for tuning in today. Dennis, thank you very much for your time. Please stick around for a couple of minutes afterwards. Everyone else, Tech Behind FinTech, we go live 12 p.m. EST every Friday. You can also go to our website and subscribe to our newsletter. We have a free newsletter, latest FinTech news, the guests we're going to be interviewing, and also some catch-up stuff. So you definitely want to be involved with that at the techbehindfintech.com/subscribe. To all, have a great weekend. Make today wonderful. Like I always say, whether you watch this live, whether you're tuning in tomorrow or next year, I thank you for your viewership, and I thank you for all the messages you send behind the scenes. On that note, to all, have a great day, and cheers.
Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.